What if the sudden surge in demand for credit default swaps on U.S. Treasury bonds, the same insurance that only made headlines during the 2008 meltdown, is the red blinking light that decides whether your next decade is defined by leverage or by lockdown? Imagine waking up on X date to find overnight money markets frozen, your adjustable rate mortgage recalculated, and the promotion you trained a year for evaporating because political brinkmanship turned into a liquidity crisis. The price of protection on one-year treasuries has already rocketed from 16 to 52 basis points since January, its highest in 2 years, while 5-year contracts hover near 50. Investors are afraid not that America can't pay, but that Congress might not sign the paperwork in time, proof that political dysfunction, not insolvency, is now the dragon men must learn to slay. Let that sink in. Each extra basis point represents billions in perceived risk, and history shows these spikes coincide with cliff-edge showdowns in 2011, 2013, 2023, and now 2025. Throw yourself into the future. It's late July, the Senate recess is hours away, and Treasury Secretary Scott Bessent warns cash balances could hit zero before payroll. Money market funds gate withdrawals, corporate treasurers hoard liquidity, and the very U.S. bonds once hailed as risk-free become collateral nobody wants overnight. Flashback to 2011. S&P stripped treasuries of their AAA halo, equities plunged 17% in 2 weeks, and retirement dreams aged 10 years in 10 trading sessions. Positive outcome if we move? You insulate your cash flow, lock borrowing costs, and capitalize on market mispricing. Negative outcome if you coast? You're the bystander refreshing news apps while every financial plan you built on risk-free assumptions gets audited by reality. Consider Marcus, a mid-30s engineer who ignored the 2023 ceiling scare. His employer issued floating-rate bonds to fund expansion. Marcus poured bonuses into company stock, betting on a rally after the standoff. When policymakers passed the deal at the last minute, rates still ratcheted higher and quarterly debt payments doubled, slashing R&D budgets and vaporizing Marcus's options package. Meanwhile, Leah, a viewer who caught the CDS flare early, shifted 20% of her portfolio into short-duration Treasury ETFs, trimmed exposure to her firm's variable-rate debt, and stashed 6 months of operating cash for her design side hustle. When markets wobbled, she bought distressed equipment with a steep discount and doubled her production capacity before competitors even reopened credit lines. 2 professionals, 1 headline, vastly different outcomes. Interpretation and decisive action are the multipliers. Start carving an antidote today. First, construct a liquidity ladder: 1 month cash in a top-tier checking account, 2 months parked in a government-only money market fund, 3 months in a rolling 13-week T-bill ladder you can liquidate weekly at auction. Second, run a stress test on every personal liability, mortgage, auto loan, margin account, adjust the rate up 2 percentage points and ask, could I float this for 6 months? Third, cultivate an income hedge that rises with political noise, consulting on regulatory compliance, short-run manufacturing for reshoring firms, or data cleaning for municipal bond analysts. Gentlemen, when did a political fight last threaten your paycheck or portfolio? Drop the moment in the comments. Your cautionary tale will help every subscriber here spot the next flare, and in exchange you'll harvest a playbook of crowdsourced defenses you can deploy before the window shuts. Still think a last-minute fix makes preparation optional? Moody's just sliced America's sovereign rating to AA1, a symbolic cut that nonetheless nudges global risk models. If spreads remain elevated, foreign holders may demand higher yields, and suddenly refinancing that adjustable rate loan or issuing new venture debt costs you real money. Picture the headlines: Congress punts vote until September. Equity traders dump cyclicals and your RSUs drop 18% in a single Friday close. The pause you banked on becomes a vacuum. Aggravation Phase 2. Even if a deal passes in July, the follow-through includes another $4 trillion in potential borrowing, flooding the market with fresh treasuries. Yields rise, bond prices fall, and anyone forced to sell fixed-income assets to meet expenses realizes the paper safe haven was only safe for those who didn't have to exit early. Full toolkit time. Pillar 1. Refinance any variable debt into fixed terms while lenders still assume August bliss. Pillar 2. Pre-fund major 2025 cash needs, property taxes, tuition, big equipment, before short-term rates spike. Pillar 3. Accumulate high-quality short-maturity corporates or tips that historically outperform when the long end sells off. Pillar 4. Monetize macro literacy by producing bite-sized financial explainers, selling them to HR departments desperate to calm staff pensions you earn while others fret. Pillar 5. Negotiate a political risk bonus at work, % of salary paid up front for leading cost-saving projects that protect margins if government-induced volatility lingers. Execute these sequentially, schedule weekly checkpoints, and you turn sovereign drama into personal ballast. Now amplify your edge. Track CDS spreads daily. 50 BPS is the hair trigger, 60 the fire alarm. Pair that with Treasury bill yields and Fed funds futures. When CDS widens but short-term yields lag, the market is giving you discounted insurance. Buy it. Conversely, if yields spike yet CDS stays flat, liquidity, not default, is the scare. Deploy cash into battered but solvent issuers. Layer in skill stack upgrades. Learn to model scenario analyses in Python or master public speaking so you can articulate these dynamics to decision makers and get tapped for leadership when crisis meetings erupt. Knowledge without articulation is invisible. Visibility during uncertainty is leverage gold. Momentum rewards the prepared observer, not the casual optimist. By the time the next ceiling vote rolls through, your liquidity, skill stack, and income hedges should be locked and humming. Subscribe now because our next drop breaks down live trading tactics for the final Senate negotiations, real-time moves, no econ jargon. Hit like if turning political theater into personal growth resonates, and share this episode with one friend clinging to the government never defaults mantra. Help him armor up before complacency taxes his future. Stay sharp, stay proactive, and I'll see you on the next stride forward.